Hey everybody, Jack Lucky, Mortgage Advisor here, and welcome to episode 3 of Mortgage Myths. In this video series, I am debunking things that I have heard in my years in the mortgage industry. These are phrases that have been said by other mortgage lenders, realtors, and even other borrowers that are not always exactly true. So let's get started, and I hope you guys are ready because this one's a doozy. Here we go. Mortgage myth number 3. Our special loan program allows less than 20% down with no PMI. I know you've seen ads for these before. They advertise to first-time home buyers that they can get into a house with less than 20% down payment and still with no PMI. And I'm here to tell you today that that is technically, well, it's technically true, but it's a little misleading. Now, I know I'm about to get some hate mail for this one. The other lenders out there that market these things do not like having this pointed out because this is an advertising tool for them. And they want you to think that you're getting some special deal where you're getting into a house with less than 20% down and not paying PMI. But I'm here to tell you the whole truth today about how these programs work. So, first off, let's get into what is PMI. PMI stands for Private Mortgage Insurance. And in order to get a good definition of private mortgage insurance, I went to Consumer Financial Protection Bureau's website. And this is the definition they gave me. Private mortgage insurance, also called PMI, is a type of mortgage insurance you might be required to pay for if you have a conventional loan. Like other kinds of mortgage insurance, PMI protects the lender, not you, if you stop making payments on your loan. So to put this in layman's terms, I guess I'll kind of tell you a story. Back in 2008, there was a big housing crisis, right? Everybody knows about the big housing bubble that burst. And when that happened, a bunch of people foreclosed on their homes and they were underwater on their loans. They owed more than the home was worth. And that was because lenders were giving out loans with minimal down payments to borrowers that had no business getting those loans, couldn't afford the payments. So when they defaulted, these lenders were stuck with houses that were worth less than the outstanding loan balance. So they have this thing called private mortgage insurance, which is an insurance policy that protects the bank if you stop making payments on your loan. It will pay them. It's kind of, think of it like gap insurance. You know, if you have gap insurance on your car, if you owe more than the car is worth and you wreck the car, the gap insurance pays the part of your car payment that your insurance company won't cover because the car wasn't worth it. So this is kind of like that. This is gap insurance, but for lenders. All right. So that's basically what PMI is. And it is pretty well mandatory on every loan where you're putting less than 20% down. Now, here's where the technicality is. These loans out here don't have PMI. And that may be true because what they actually have is other kinds of mortgage insurance. So let's get into this a little bit more. What types of mortgage insurance are there? So first off, we have private mortgage insurance. Now, these are private mortgage insurance because they're private insurance companies like Genworth and ArchMI and Essence and all these companies out there that insure mortgages, mortgage insurance. And they have all kinds of different varieties of these. You can get upfront mortgage insurance where you pay the whole thing up front. You can get level premium mortgage insurance where you get a level premium for it every month for the 30 years of your loan. And most of these are the variety where if you get to 20% equity in your home, you can get these removed and not pay PMI anymore. So this is kind of your standard PMI. That's basically what that is. There's another variation called MIP, or mortgage insurance premium, and that is only for FHA loans. FHA loans have their own version of PMI called MIP. It's not private, it's government controlled. That's why it's not private. It's mortgage insurance premium. And this one for FHA loans is a combination of upfront MIP, so like a percentage of it paid right up front at closing, and then also a level premium through the life of the loan. The third one is a guarantee fee for USDA loans. Now, it's not called PMI, it's not even called MI, it's just called a guarantee fee, but it's the same thing. It's administered by the USDA, and it is just like the FHA one. There's a combination of upfront and also ongoing every month guarantee fee tacked onto your monthly mortgage payment. The next one's called a funding fee. This one's for VA loans, and it is the same thing. This one is only upfront though. That's a notable difference with the VA loan versus, or the VA funding fee versus other types of mortgage insurance, in that this one is only upfront. It is not ongoing through the life of your loan and not added onto your monthly payment. They do, however, typically finance this fee and add it to your loan amount. So you're technically paying it up front, but you're actually paying interest on it for the full 30 years because they added it to your loan amount. Now, I'm going to pause here and make one important distinction, because there is an exception to this entire video right here. There are certain criteria. Typically, disabled veterans can get the funding fee waived, as in they don't pay it at all. And they are the one exception to where they do not pay any kind of mortgage insurance for their loan. Now, these are fully disabled veterans or surviving spouses of deceased veterans in certain special situations. I'm not going to go through all the exceptions there, but suffice to say, these veterans and surviving spouses who have sacrificed so much for their country, they deserve to be able to buy a home without mortgage insurance premiums or mortgage insurance. So they are the exception to this entire rule. Lastly, lender paid mortgage insurance. Now, this is really where these ads come from. So this is mortgage insurance, typically PMI, private mortgage insurance, that you will never see on your loan. And this is where these ads come from. No PMI. It's because the lender is paying it, but you know they're not giving it to you for free. These lender paid mortgage insurance programs, they basically hike up either the fees or typically the interest rate on your loan in order to cover the cost of the PMI. So anytime you're looking at one of these loan programs that has no PMI on them, but they're taking less than 20% down, look at the fine print, look at the fees, look at the interest rate versus other loan programs out there. You are paying for that PMI one way or another. So that's why I deem this myth misleading technicality. So it's not technically misleading because it is true their loan may not have PMI because they call it something else, or because they're paying for it some other way, or you're paying for it some other way, to be clear. So I just want to say this, the purpose of this whole video is that there is no loan out there where you can put less than 20% down and not pay for that added risk to the lender in some way, shape, or form, unless you're a disabled veteran. We thank you for your service. Thank you so much. I hope this video has been helpful. We'll see you next time.